Howdy, friends. Welcome back to Feedstuffs 365. I'm Andy Vance, joining you for a look at what's happening in the commodity market, specifically as it relates to the feed ingredient space. Feed grains have been on a tear for a variety of reasons. The global marketplace is as challenging as ever. And to join us to sift through those and what's happening in the livestock markets, as well as Richard Brock of Brock and Associates. Richard, these markets are wild. I appreciate you coming on board as you do from time to time to help us talk about what's happening out there. So with summer grilling season underway, unrest continuing, and the Russia-Ukraine conflict, and a whole host of other things related to inflation in the global energy complex, stage is set for an interesting talk, my friend. I'm going to turn this over to you to tell us what's happening out there in the marketplace.
All right, Andy, thanks. And it's a pleasure being back with the group. As we were talking before this, as we were getting set up, I was explaining that yesterday I had the honor of speaking, doing the outlook for the Animal Nutrition Association of Canada, their annual meeting, which was held in Niagara-on-the-Lake. If any of you have never been there, I would be a good promoter there. It's just a beautiful place to have a conference. And some of you on here may have even been there, but it's definitely a lot of things to talk about today. So I will go through these as quickly as I can. I have more slides than I'll be able to talk about. As always, because we're registered advisors, I had to put this disclaimer up there that there's always a risk of losing money in futures and options, etc. All right, a few of the highlights that we need to address. Obviously, inflation is a large one. It's impacting labor rates. Meeting with clients in Western New York yesterday, one of their biggest issues is, besides bird flu, is the inflation rates and what they're having to pay all their employees. Debt's a big issue. Labor force, as we all know, is just a real problem for all of them. And transportation costs, and unfortunately, the public, they look at the price of meat and they think everything's expensive, and so they think the pork producer and the beef producer are making a fortune. Don't realize that the real increases have mostly come from processing costs and transportation costs, not what the producer was making. But we are seeing consumer resistance, particularly in the beef. Beef per capita consumption is down. I didn't realize, but in Canada, beef per capita consumption has always been substantially lower than in the United States, and that is even dropping. The Russian-Ukraine situation, a lot has changed there in the last 10 days. I'll cover that. Energy costs, obviously, planted corn and soybean acres, we pretty much know what that is now, bird flu. And of course, the other issue we're all concerned about, and what's doing to the oilseed market, is the renewable diesel demand for oilseeds. And so just a lot of things happening, a lot of moving parts. Bull markets always result in a lot of issues. Farmers in the grain industry like it, but in reality, the long term, it hurts them because we see a sharp increase in input prices, fertilizer, chemicals, and etc. And then the grain markets peak, and we think corn already has. We think we're in the early stages of a bear market in corn. I'll explain that later. And then you take a look at what's happened, and a lot of you in the industry. I mean, there's been a lot of speculative returns in the grain industry this year, but there hasn't been a lot of storage returns as for basis improvements unless you're in some specific areas of the country. And of course, that has ramifications in the feed industry. The capital requirements for margins, maintaining grain positions, basically tripled this year. And so everybody was revising their lines of credit to be able to meet the demand. And always when this happens, we see some people leave the industry saying, I don't have the emotional strength to put up with this anymore. A few quick comments on the economy. Here's when this new administration came into office, and of course, because of the pandemic, they pumped huge amounts of money into the economy. And whenever you get more money chasing the same number or fewer goods and services, you're going to have sharp inflation. And the other thing that's kind of interesting is it's true around the world. This is a similar chart overlaid on the S&P 500, and it shows the stock market pretty well parallels how much money is chasing it. And of course, we've had a huge correction of the downside here in this past 6 months, but longer term, the trend is likely still up. So it's just an extremely volatile situation. I think this is interesting, particularly those in the Midwest. Everybody recognizes the farmland prices have gone through the roof. Here's the amount of money at the first year of the pandemic the federal government and farm payment programs to ag producers. As you can see, it is enormous, absolutely enormous, almost $50 billion. And now this year it's going to be about $10 billion. This really helped fuel the farmland market in the last 2 years. You add in, the sharp bull market in grains, and then you throw in all this amount of cash too, and farmers are going to spend that money on dirt before they spend it on anything else. And it's been absolutely shocking. Most Midwestern farmland values just since last August are up over 40%. Biggest bull market we've ever witnessed. Energy markets, again, here's where we were about 2 years ago. Our imports were very small. Now, of course, they've all ramped up. Our exports, believe it or not, we do export a fair amount of oil, mostly processed oil, obviously not crude oil, and that's remained relatively flat. There's a crude oil price up to date through yesterday. We just keep making new highs. Honestly, I don't know what's going to slow this energy market down. This administration is not going to allow fracking to come back on government-owned land, and that is what's needed. We need to reinvigorate the development and finishing the Keystone Pipeline coming out of Canada. But folks, I think we all recognize under this administration, those things are not going to happen. And so far, the price of gasoline and diesel fuel at the pump hasn't stopped consumer travel. It's just incredible. People are still wanting to travel. Every flight I've had in the last 2 weeks has been packed. And, airline rates in the last 4 months have essentially, in my opinion, doubled. But yet you take a look at some of the commodity prices that are driving the economy. The lumber market is trading near the lowest level it's been now in 3 years. Everybody, heard about the cost of building going up and up and up. That was here. And then the lumber prices collapsed, had another big move up, and now the lumber prices are collapsing again. But unfortunately, that it takes a while for that to work through to the retail level, because you take a company like a Menards or Lowe's, they buy here, they're going to wait until that inventory is gone before they start coming in with lower prices. Copper is at the lowest price it's been in a year. Again, a leading indicator on the economy. And here you are with rolled steel, a huge move up. I mean, went from $500 to almost $2,000, and now back down to 1,000, and now we're coming down again. So this is really impacting and making business difficult for companies in the manufacturing of livestock equipment, grain bins, and et cetera. Because when you're going up in a market, those companies can just keep increasing their prices. But what if you bought a lot of steel for either grain bins or cattle or hog equipment here, and then all of a sudden it collapses, your competitors are buying it down here and you bought it up here? That makes it very challenging on product pricing when you get into a bear market in steel. It's more difficult actually than a bull market in steel. So those are just some changes. Aluminum prices have collapsed. And so you take a look at a lot of these other odd and end commodities, it would indicate that the commodity or the economy is going to start slowing down. Fertilizer prices, as most of you know, at the wholesale level in the last 2 weeks have dropped 25%. Hasn't showed up in the retail pricing level. Farmers are not buying fertilizer right now. But if you look at the wholesale prices of fertilizer, they've already started to soften. And now let's turn our attention to Ukraine. The last 5-year average, Ukraine accounted for 14% of the world's corn exports. When you take a look at wheat, between Russia accounted for 19% and the Ukraine for 9%. So very major players in the wheat market. And so as a result of that's why we've seen such a bull market in wheat. And also this last leg up in corn. And a lot of people assuming, well, this could go to nothing because the Ukrainian farmers are not going to get their corn planted. Well, guess what? Those rumors were not true. As of today, in fact, the ag ministry in Ukraine has stated that about 89% of the Ukrainian corn crop is planted at 12.64 million hectares. And that's about 78% of what they planted last year, and it's all in the ground. What we have discovered from some of our clients that have operations in the Ukraine, most of the inputs were shipped into the Ukraine prior to the war starting, and the rumors of the Russians destroying the farm equipment and and grain handling facilities and the unavailability of diesel obviously has just turned out not to be true because the corn crop is in the ground, and that's what's causing this market to really start to trend sharply lower. Now, in the May crop report, the USDA forecast that the Ukrainians would produce about 19.5 million metric tons of corn. Previous year was 42 million. This number is wrong. They're going to revise that. Our estimate is right now it'll probably be at least 25 million metric tons, and we'll get to that here in another graph. I don't remember if I've ever shown this group or not, but in 9 years ago, I went to a cruise of the Black Sea with a group of farmers, many of whom are part of these associations, and some of you who are on the agribusiness side. We started in Istanbul and went up through Bulgaria, Romania, and then into Odessa, which is right here. Then we swung around and hit Sevastopol and then Yalta. But here's your corn producing area, and again, this is about 90% planted now. And then we take a look at the wheat, and the wheat is more in the southern area, and of course this the spring wheat is also pretty much planted in the. And I'll just go through these slides real quickly. These are pictures that I took when I was over there 9 years ago. I don't know, someone else, some of you listening to this know, but at the time this was a CHS facility, and it was only 2 years old at the time, and again, so now it's 11 years old. And this is one of the biggest grain exporting facilities in Odessa, and it's still standing. It hasn't been damaged. Their technology, the way they do things, though, is just, everything's still very old. This was a rail unloading facility. Nothing's very sophisticated. Rail cars are small. Rail tracks are small. Trucks are small. Roads are small. It's just a very different system than what we're used to. I had to take this one because they were all Brock grain bins and Brock drying systems. So I'm a little bit prejudiced because of the name. Here's a semi-unloading in that same facility. Here's what it was like over there 30 years ago. This is what farming is like in the Ukraine right now. They have all the largest combines, a combination of Kloss combines, which of course are made in Germany close by, John Deere and Case IH. I mean, they're all over the place. It's big farming. It's not a bunch of 10-acre parcels in the Ukraine. And so once they get going, they can go pretty fast. So anyway, the long story short is farmers who were bullish and was thinking this was going to push the grain market into all-time new highs. That's not going to be the case. Now their focus is going to have to turn to weather. And as you can see in the western part of the United States, the drought concerns are huge. Now, earlier this week, though, many areas of Kansas got 4.5 inches of rainfall. And so that's another issue that helped collapse the wheat market early in the week. If we go back to 2007, we see how things changed. 2007, U.S. corn farmers had over 60% of the world's export market. It's now slightly over 30. Ukraine had nothing, went up to 14%, and now because of the war, it's going to be off some this year, but still has really changed it. Show this too. A lot of people think that because of the export problems in the Ukraine, we'll pick up a lot of export. Folks, in our opinion, that's not going to happen at all, because here's the countries that the Ukraine exported to 2 years ago. Eastern Europe, China, we might pick up a little bit of corn from China, but so far we're behind last year. And North Africa, we're not going to export corn to them of any magnitude. The Middle East and South Korea. So you take a look at where they are in the globe, and you take a look at the shipping channels between here and there, and it doesn't take long to realize that we're not going to pick up a lot of exports. Now, this is based upon the last USDA crop report, where a year ago, Ukraine produced 42 million metric tons. The USDA says it's going to be 19.5 this year. They're going to have to revise that between 25 and 30 in the next crop report. This is just not going to happen at all unless they don't have any weather problems with getting 90% of the crop planted, the equivalent of last year. And then so their exports are going to be a lot more than 9 million. They won't hit last year's 23 million, but we believe they'll be back above 15 million metric tons. We take a look at our planted acreage in corn and soybeans, obviously going to jump this year. And the big question here becomes next year. I mean, this is going to be a real challenge. There are many. I've heard rumors of as many as 14 new soybean processing plants coming online, or at least are on the drawing board to produce renewable diesel oil for renewable diesel to go into California. Now, we clearly don't have enough soybeans to fire that many processing plants. It's just not going to happen. It's physically not possible. So, what's going to happen, in our opinion, is we're going to see a continued sharp increase in soybean production from Brazil, and they're going to continue to increase their overall world exports. Crop production or planting progress in the U.S. as of a week ago, 86%, only slightly behind normal. So crops a little bit behind, but nothing of any significance. July and August weather is going to be much more important than the planting date at this point in time. Long-term cycle in corn, we're probably completing this one now, and we don't obviously. Things are going to get something's going to happen to the weather in order for us to take out the 2012 top, but we think we're making right now a fairly major cycle top in corn. Take a look at a balance sheet of corn, and again, these are our estimates. USDA's are right here. We're looking at this is the old crop corn. If corn was harvested last fall, we're looking to carry over as much as 1.44 billion bushels, stocks to usage ratio of 9.6%. And folks, that should give us an average price significantly below where the market is trading right now. If we planted 89.5 million acres, that could be closer to 89 million. We're still looking at a big carryover this coming year. Stocks to usage ratio is still around 9%. And in our opinion, this is lower than USDA is. We're looking at an average price more in the low $6 range. And as we talk right now, looking at a price screen, we have December corn at $6.93. And so we believe the corn market is fundamentally overpriced if we have anywhere close to normal weather. Now, plant only 89 million acres, throw in some weather issues, only have a yield of 174. If you want to be a bull, that'll take your carryover down to 834 million bushels, and then you have $10 corn. So I'll be a two-armed economist here and say, okay, if you have serious weather problems now this growing season, you've got a chance that the corn market can make a new high. But if you have good weather, you have a chance that the carryover could go to 1.4, 1.5 billion bushels, and then you're in the midst of a significant bear market. So all things told right now, again, we think this market is topped in the corn and in the wheat, and will carry over somewhat in the soybeans, but soybeans may not be done yet. That's a graphic representation of carryover supply in corn. And here's why I say that I think this market is grossly overpriced. You have on the horizontal axis, you have the ending stocks to usage ratio and the average price of corn to farm on the left axis. And this equates to a central Illinois price. That's a pretty normal national average basis. Forget this price curve here. That was back when we had the LDP days and farmers made more money the lower the market went. Here's our price curve for today. And so each one of these little triangles is a marketing year. So for example, in 2012-13, the market averaged about $7 a bushel. Stocks to usage ratio was about 7%. In 2011, we averaged about 650. Stocks to usage ratio again under 8%. So here's the expected stocks to usage ratios now, and if it came in on the price curve, the average price comes in closer to $5, not the one that the USDA is using. And the same thing is true for next year. So unless something changes, we believe the USDA's expected average prices are quite high in corn right now. And with the way the market is trading and the technical trend, this market's in a severe downtrend. Today's ethanol production numbers came out. We're back up here. Ethanol production is strong. Strong gasoline prices, should be helping the price of ethanol. Usage should be going up a lot in ethanol because it's so much cheaper than gasoline right now, and processing is increasing. Exports are behind where we were a year ago, but still above the 5-year average. The amount of corn we're exporting to China. China was never a buyer of corn of ours until 2 years ago. And this chart goes a long ways back. And this year is still pretty good, but not as good as last year. But relative to historical levels, it's very high. I'm going to fly through a lot of this so we can talk about more about the prices. This is a July corn chart up to date through yesterday. The sell signal technical, if those of you who have been following us for a long time, the 5-week Friday close rule, which we think is the most valid technical indicator in corn, gave a sell signal on May 20th. And that is, it was the lowest, that day was the lowest Friday close in the previous 5 weeks. And it'll stay short until it reverses and closes higher than the previous 5 weeks close. This is the first real technical sell signal in corn we've had since October of last year. And so, we jumped all over. We were aggressive sellers in corn in the last 2 weeks and pretty much just quit for right now. But we want to be heavily sold in this market for producers, and for buyers of corn, we just want to buy hand to mouth right now. There's no reason that we see to be aggressive buyer in corn. We think the basis levels will soften. This was up to date through yesterday. Again, major technical sell signals, and right now that matches the fundamentals in our opinion. And so we just want to sit back and watch this market and buy hand to mouth. December 23 corn, same thing. We believe these are very high prices for 23. We've already sold 10% of that crop. Soybean planting progress, again, we're behind normal, but we're catching up quickly. I think this is supportive for the bean market right now because of ones that are being planted. What's being planted right now in Illinois and Iowa, mostly soybeans because they got started late. In this market, though, I think still fundamentally we're looking at a 235 million bushel carryover this year. If we plant 91 million acres and have a trendline yield of 51 and a half, that carryover is going to go up this coming year. But everyone that's raised soybeans know this is way too early to predict what soybean yields are going to be. July and August weather is extremely important, and late planted beans has a more negative impact on soybean yields than late planted corn does. And so I think this is a concern in the soybean market because we're getting the crop in later. Corn, I don't think it's going to hurt it, but soybeans, it very well could. Let me fly through some of these. Here's our export numbers. I mean, they're actually starting to catch up with where we were last year. Exports to China are down 19% from a year ago. China in the last month and a half or so have been buying most of their soybeans from Brazil. We think that trend is probably going to continue. We look at export sales to China. As you can see, the long-term history, it's very strong. It's probably the third strongest year we've had in the last 10 years. So while it's down from last year, it's still extremely a good export number. Now, this is the one I think is really going to go crazy. At least Brazil has a lot of land they can still bring into production. We really don't. And they surpassed us 5 years ago in production worldwide. They're going to really surpass us this year. And we think this gap could accelerate over the next several years. I don't see how we're going to stop it. But we don't see where our soybean production is going to come from if we're going to really build all these processing plants for renewable diesel. Carryover is still relatively high in soybeans, U.S., as you can see. This is a chart up to date through yesterday as I talk right now. November soybeans are up 24 3/4, trading just 6 off their high. So we're back up into this area right here. Your guess is as good as mine where this could go short term. We're selling beans at this price level for producers just because this is a very high, very profitable price. And then we take a look, though, in November beans, the same thing. We take a look at meal. If we're going to be processing all of these beans for soybean oil, we're going to have a glut of soybean meal. I think it's very difficult to get bullish soybean meal. And even though we're up, we're not up much at all here today, a buck a ton. And but soybean oil, again, is going through the roof. That's where all the demand is. And so we're going to keep processing beans to get the oil, and we're going to have a glut of meal. So I don't think any reason to get in a hurry there. And here's the soybean oil, and again, like it's up over 200 points right now, up 230 points. So it's up in here. So soybean oil is going to continue to march north and leave the meal behind. Just a couple comments on wheat, and I'll make a couple comments on cattle and hogs. Then we'll get in a question and answer. Because of the issues in the Soviet Union and the Ukraine, we've had an enormous bull market in wheat. But the reality is, rains are now starting to come in to Kansas and helping alleviate some of the drought areas. This market with a carryover, we think now of 145 million bushels or 645 million bushels next year. This market is discounted. This kind of news. This has been a supply-driven bull market, not a demand-driven. And some supply-driven bull markets will peak quickly and they will drop quickly. Demand-driven bull markets are slow. That's not what this is. And so this is a market, and I'll just get into a chart. Here's a carryover worldwide. This is where we're at right now. This is the lowest price we've seen now in 2 months. I mean, this is a substantial drop. July Chicago, we've gone from 12.50 to 10.50, so $2 in the last 2.5 weeks. That's a significant move. Short term, we've been aggressive sellers, but I think we could rally back up into this area, maybe a 30-40 cent rally. Today, I'm looking at my price screen. July Chicago wheat is up 21 cents right now, but that's 13 cents off of the high of the day. So it's going to be extremely volatile in the weeks ahead. But now I think it's confirmed, both July and Kansas City, that this is now a seller's market and rallies need to be sold. Comments on the meats, and open it up for question and answer. Poultry production continues to ramp higher. Pork consumption is we expect to be up slightly, but beef production this coming year down about 6.88%. And we look at the per capita consumption, again, a pretty sharp drop in beef. So I think we are seeing consumer resistance to beef. I think a lot of people are saying, look, $21 for a pound for New York strip in the grocery store, that's a little ridiculous. Maybe even 18 is ridiculous. Or you go into Ruth Chris and you're paying $75 for a steak. It's a good idea if someone else is picking up the tab, but I don't want to go in there and pay that. And I think a lot of consumers are saying the same thing. But we've seen all competing meats. Fish prices have gone up. So all seafood prices have gone up substantially. Everything's going up, but we are seeing the beef market hit hardest because of price resistance. We take a look at cattle inventory, though, really not increasing a lot. We're above cattle and feed, above where we were a year ago, well above the 5-year average. So the production is good. But with all of that said, we think this was you reverse this. I just marked the charts for tomorrow's Brock report. Now what you have is a 1, 2, 3, 4, 5, and we're having a 5-wave buy signal today. V bottoms in cattle are very reliable. We think this market made a major bottom this week, sucked in a bunch of new shorts. And so what we're doing right now is we started buying feeder cattle. Again, the same thing, 1, 2, 3, 4, 5-wave buy signal given here. And so we want to be pretty aggressive on buying the feeder cattle. And if we're right, which I think we are, on what's going to happen in the corn market, the demand for feeder cattle is going to increase significantly. I really like this market. I want to own it. I think, and I don't want to be buying the feed to feed them right now. Just go naked long cattle, either the real thing, feeder cattle, the real thing, or the futures, and then wait to buy the corn as you need it. So some real good opportunities, we think, in the feeder cattle side of things here in the next year. Hog inventory is down slightly, and we're seeing production declines. Obviously, disease has been a huge problem for the pork industry, as bird flu has been for the poultry industry, and it's really hurting production numbers substantially. Those of you in the hog industry, I don't need to tell you that. Everybody knows it. Breeding herd is down, so the numbers are down. And as in cattle, you reverse these numbers now. You had a 5-wave buy signal. We do not want to be short hogs. We want to stay open in all production. We believe this whole market is going quite a bit higher on the pork side, and because we're not increasing numbers, we're decreasing numbers, and consumer resistance to pork prices just are not there. They're doing really well. And with that, I'll wrap it up. If any of you don't take our Brock report and want a 1-month free trial, call that number. Our ladies in circulation will help you take care of you. There's lots going to happen here in the next few weeks, so call in there and you can get a free 1-month supply. But with that, Andy, I open it up to any questions. I talked 29 minutes, and that's enough.
Yeah, right on the money, Richard. And echo that, friends. If you've got questions for Richard, please put those in the comments area. We'll get through them as many as we can. I wanted to start there talking about the meat markets, Richard, because I'm thinking, okay, Memorial Day is the unofficial start to the summer grilling season. Certainly, you and I are probably enjoy a nice steak on the grill out back. But you talked about that resistance from the consumers to some of the prices we're seeing at retail. They're not changing their travel habits, but maybe we're starting to see changes in purchasing habits. Do you think that whole inflation picture is starting to exert some squeeze in a couple of these
I
markets?
think it is, and I don't think consumers recognize that the biggest part of the increase is processing and transportation costs. And it's not to the benefit of the producer. And I think the producer is going to start to benefit more, but as the wholesale prices then start to increase, it's going to cause more resistance. So I think as we go into the grilling season, we're going to see probably a shift to more demand for pork products. It's going to be good for the pork industry. Pork chops. We might see a bigger demand for bratwurst, which is obviously not pork, and it's not going to slow down. The sales of camping equipment and trailers and all that, it hasn't stopped. And so, as long as that's strong, you're going to see strong demand for outdoor cooking. And so those seasonal demands will continue to be there. But when we take a look at the steak demand, I'm a little concerned about it. I mean, people are saying, there are other good products I can eat without going in and paying $35 a pound for organic beef. I mean, I don't know. I don't follow that market, but I cannot imagine that we're seeing a sharp increase in organic beef sales right now. I mean, it's got to be hurting that because the prices are just sky high. So, but overall, I think it's going to be a good summer for the beef and pork industry. And of course, everybody's listening to this that sells supplies into those two industries are going to do, I think, quite well.
One of the things I've been wondering about when you started talking about the lumber and steel markets and maybe, okay, some return to normalcy or closer to sanity in terms of prices there. But as we look at cost of seemingly everything else going up and interest rate risks, I'm wondering what you think those factors all mean for producers who are thinking about, hey, maybe I'd like to build a new barn, maybe I'd like to add some production space because of some of the opportunities that could be coming there in the cattle and hog markets. How much more complicated is that decision today because of some of the potential interest rate risks ahead?
Well, that's a very good question, but I don't think it's going to impact producers all that much because of all the cash that's available right now. Most producers have been around long enough to realize that today's interest rates are high compared to where they were 2 years ago, but based on historical comparisons, we're still really low. I mean, I remember my first house and the mortgage was 18%, you know, and there's other viewers here that can remember that. And yet my kids just think this rate is atrocious that just happened. And so, I think in the farm area, it's not going to have much of an impact, but I think it is having an impact on the housing market. And in fact, it's helping hold house prices up because people who are thinking of trading up in the house side say, I don't want to give up my 2.5% mortgage and flip over into a 5.5% mortgage. So what we're seeing is the number of listings is continuing to drop, and which is helping to give a support to housing prices. And so, unless a person is renting and wants to buy a home, they're the only buyers out there right now because people who own existing homes, they don't want to move. They don't want to if they're borrowing money, they don't want to flip. And so it's going to have an impact on the housing market, but I don't think it's going to have an impact on farmers. And we take a look at farmer borrowing on farmland right now. A lot of it's been paid for with cash, but still, you look at going into say Central Illinois right now, I'm paying $25,000 an acre for farmland. There are plenty of buyers, and it's just incredible the demand. And now all of a sudden we're seeing more investors wanting to get into the farmland side. They've been sitting on the sideline and they thought, well, no, the stock market's been better, but now the stock market's been in the dumps. People are saying, look, let's put money in agriculture. And we're also seeing more investment funds saying, can I finance? I got a call last week from a manager saying, do you have any place that we can invest $20 million in a dairy facility? These are not people wanting to run it. They want to come in as basically as lenders, and a lot of people looking at that. We've seen a lot of change in ownership in the dairy industry in the last 12 months. Some people saying, "Oh, this is a good time to get out. Milk prices are an all-time new high," and others that are wanting to expand. A big dairy family, and they got 3 sons and not enough milk cows to finance 4 families, and so they're expanding and buying dairies elsewhere. We've seen a lot of those in just the last 2 months. And so a lot of change is taking place. I mean, and the exciting thing about it is, if you have flat markets, you don't have profit opportunities. But when you've got volatility like we've got today, you have both increased risk, but also increased profitability. And so just going to see continued change and continued consolidation. Agriculture is going to continue to consolidate. 10 years ago when we thought 5,000 acres was a really, really big farm, with today's technology, you know, shift those gears to 10 or 15,000 acres,
Yeah.
because with the satellite technology, it can be done. And
Well,
so it's changing.
I want to go back to where we started at the top of your presentation, Richard, and talking about the money supply, all those trillions of dollars out there in the marketplace. As you watch what the Fed and the administration and others are doing, or you could be talking about the Europeans and the Bank of Japan and so on. What are your feelings about the trend and the plan that the governors and such have for trying to get a handle on this inflationary environment? Are they making the right moves, or do some Monday morning quarterbacking for me, Richard?
Well, I will. I think the Fed is a year and a half behind what they should have been doing. They waited too long to start ramping up rates. I mean, they just totally missed the boat. And so, I mean, I think most anybody that watches what they do would agree with that comment. And so that means you have to play catch up and increase rates faster and higher. And we're still having rates way under the inflation rate. So these rates have already announced they're going to have at least one more increase, and I think they're going to have more. We've got an inflation rate in real life of more than 8%. And so until you get an interest rate above that, you're going to continue to have more and more inflation. So it's frightening what's happening there, and so we're going to drive rates higher yet. Now, will we get back to where we were in the 1980s? I just say I certainly hope not. Now, you get rates above 10%, then I think you'll really choke this economy, and I think within 2 years we're going to be back into a softening money supply situation. I think they'll overdo it, overcook it, and then 2 years from now we'll be looking at this thing trend the other way. The other thing that, and this is not all tied to animal nutrition and economics, but the demographics of what's happening in the United States right now is also extremely concerning, about how people have left the more expensive cities and moved more rural areas. But the one that is most profound, and I didn't realize it until a family reunion this weekend, and one of my nephews who lives in Los Angeles, he says to me, he says, "Rick," he said, "do you realize that our enrollment in California public schools is down 30 to 40%?" And I have not seen that. I've never seen that statistic. He said, "We've got a lot of empty schools." And because some of these schools, when the pandemic hit, they didn't do it virtually. They just shut down. And so a lot of families were leaving California, not only for economic reasons, but for education reasons for their kids. They had to go to a state where they still had schools. And so, this is a profound problem in the state of California. If that many schools have closed, or they're running at that kind of capacity, and it's put a burden on a lot of other school systems that have taken these things over. So, we're facing some huge demographic issues. And of course, California's solution to that, well, let's raise the state income tax from 13 to 16%. You get in a spiral like that, and I don't know how you save a state like California for that downward spiral. And it just keeps getting worse and worse. And what we will see, though, is a change politically. We'll see some big political moves here in the next, not only this November, but 2.5 years from now. So those are all issues that may not have a nearby impact on ag producers and the group listening to this, but I think it has a profound impact on our U.S. economy and where we're headed. And I'm not going to get into issues like gun control, et cetera. I mean, this has been an emotional 2 weeks for everybody, watching what happened in Texas. And so it's going to change. I think a lot of legislation is going to occur. I don't think you can legislate away gun control myself. I mean, criminals are going to get them no matter what. And but it's a big issue. And but I'm getting off track here. But I think as again, I want to get back on the economics of the pork, poultry, and beef industry. I just think it's going to be a tremendous year. Because the demand, other than beef resistance, we're seeing strong demand everywhere, and people want to get out and they want to live and they want to eat. So we're in a great business. People still have to eat.
Yeah, yeah, well said, and a great place to end it. And folks, as Richard mentioned earlier, encourage you to take the Brock Report. Great insights there, and look forward to having you back again sometime between now and the midterms for sure, Richard. And we'll look forward to that conversation then. Friends, great week of programming coming up next week. We will be on the road at World Pork Expo in Des Moines, Iowa, so we'll be taking the pulse of the pork industry there as producers and industry influencers gather. Look forward to a great week of coverage. If you're there, do please stop by the Feedstuffs and National Hog Farmer booth in the Varied Industries building and see us. You can visit Feedstuffs 365 for a bit of a preview of what's coming down the line, some of the conversations we'll be having with industry leaders there next week. And of course, would encourage you to follow our social channels as well. You can do that at Facebook, Twitter, LinkedIn, pretty well anywhere you congregate socially, we'll be there. Until next time, for the entire Feedstuffs team, I'm Andy Vance reporting.